Hello everyone, Newborn Investor here and welcome to another video. The past couple of weeks has seen some crazy price action in stocks like ticker AMC, GME and CLOV, giving them a new name, meme stocks. So why exactly this is happening and what is causing these massive moves? In today's video, we are going to talk about this, so buckle up and stick around as we are starting right now. By definition, a meme stock is a stock with excessive trading volume from retail investors fueled by social media mentions. GameStop was the first meme stock reaching almost $500 per share, followed by AMC, and we have a new one this week, ticker CLOV. Entire float or shares outstanding of these companies exchange hands in a single day with parabolic price action. These massive moves expose some gaping holes in a financial system where retail investors are set up for failure. So how do they really screw up retail investors? We will get to it in a minute, but before that, if you like the video and find it valuable, please make sure to hit the like and subscribe button. Your humble gesture keeps me awake at night and motivates me to put in the long hours for making these videos. Alright, let's move on. From the early stock market days, retail investors had their fair share of losses, but things have changed lately. With meme stocks, hedge funds and institutional investors are tasting their own medicine. Meme stocks have triggered a short squeeze, and this time it's ticker CLOV. 2021 started on a rough note for Clover Health. The stock price dropped almost 58% from its all-time highs after a short seller alleged the company of fraud, making it one of the most heavily shorted stock. For the last 2 days following a retail frenzy, the stock made a comeback, rising almost 200%. To understand this price action, we need to talk about a major player that acts as the bridge between buyers and sellers, clearinghouse. A clearinghouse is a designated intermediary between a buyer and seller that validates and finalizes the transaction, ensuring that both the buyer and the seller honor their contractual obligations. It is a middleman that ensures delivery of shares to buyers and money to sellers. Stockbrokers work with clearinghouses to ensure the transaction is settled in a timely manner. About 99% of the time, trades are completed and settled without any hiccups. But on a daily basis, about 1% of the shares valued more than over $1 billion are not delivered to the buyer within the requisite 3 days. Some delivery failures linger for weeks or even months, and until that failure is resolved, there are effectively additional shares of a company's stock circulating in the form of shares electronically credited to the buyer's account. These shares are called phantom shares. They can put downward pressure on a company's share price by increasing the supply. There could be legitimate reasons for delivery failures, including simple clerical errors, but one illegitimate reason is naked short selling. In regular short selling, a trader borrows stock, sells it, and waits for the price to drop before buying shares back to repay that loan and pocket the difference. This is an ideal short selling scenario where all parties play fair. Unlike retail investors who rely on retail brokers to facilitate short selling, hedge funds and institutional investors rely on prime brokers for stock lending. These firms rake in billions and billions of dollars as fees annually and are thriving. They cater to hedge funds, acting as the trading counterpart, financing their trades, loaning stock and other securities to execute short selling strategies. So what happens when the hedge fund executes a short selling strategy and the prime broker never borrowed a stock? It leads to something called naked short selling. In naked short selling, the trader sells the shares without properly borrowing the stock. When the stock isn't properly borrowed, the buyer at the other end of the short sale doesn't get delivery of the shares within the mandated 3-day window. Now, you may think, how can a broker give you shares that they never borrowed? This is where we have a serious problem. Fast-working market makers are allowed to sell without borrowing to keep orderly markets. But naked short selling as a strategy in itself is illegal. However, it's highly lucrative and tempting for the prime brokerage and hedge funds. From the prime broker's perspective, fees can be made by lending the same shares to multiple traders at the same time. And from the hedge fund side, a naked short can be less costly since they have to pay more to borrow hard-to-borrow shares. Naked short selling increases the number of shares in supply, and if there is not enough demand, these excess shares could artificially reduce the price of the stock. Knowing these two concepts, let's discuss what is exactly going on with the meme stocks. All the recent meme stocks had one thing in common: a high short interest. These stocks were shorted heavily, anticipating the stock price to go down. Evidence reveals that naked short selling was involved. This means a lot of phantom shares or ghost shares were in circulation. A heavily shorted stock has the potential to trigger a short squeeze if the stock price rises quickly. Short sellers panic to cover their positions, and this action snowballs to create a massive demand, and without enough sellers and inventory, shorts have to buy the stock back at any cost and they bid the prices up, panicking more shorts, triggering a massive short squeeze. With phantom shares from naked short selling, the squeeze can be more brutal. A high short interest alone does not necessarily mean that the stock is a short squeeze candidate. Another factor to consider is the percentage of short positions that are out of money, also referred to as mark-to-market losses. No shorts will be forced to exit a position that continues to be profitable. A major percentage of out-of-money short positions combined with a high short interest and high stock borrow fees is the perfect recipe for a short squeeze, and this is exactly what is happening with meme stocks. Ihor Dasaniski from S3 Partners shares some interesting data about these meme stocks. According to Dasaniski, shorts are out of money in ticker WEN with $69 million in 2021 mark-to-market losses. But its short interest is not high and only a small percentage of the float is shorted. On GME, shorts are down with $7.3 billion in 2021 mark-to-market losses with decent short interest, and around 16% of the float is shorted. On AMC, we have a short interest of $3.6 billion with 11.5% of the float shorted. AMC has high short borrow fees, making it difficult for the shorts to maintain their positions. Finally, on CLOV, over 30% of the float is shorted with a short interest of $585 million. The fees are around 4% and shorts are out of money, which makes it a candidate for potential squeeze. With meme stocks, tables have turned and retail investors are playing the same hedge fund tactics against them. However, hedge funds are fighting back, accusing retail investors of market manipulation. Regardless of how this plays out, retail investors should be highly skeptical about hedge funds, as they will always find a way to game the system and make up for the money lost. Now, I would love to hear from you guys. Which stock do you think would be the next meme stock and why? Leave a comment below with your answer and I'll be sure to follow up with you. Also, if you like this video and found it valuable, please make sure to hit the like and subscribe button. I really appreciate your support. So until you hear from me again, stay safe and thanks for watching. Bye.